Good afternoon, everybody. Thank you so much for joining us for our panel on the future of investments in supply chain technology. I'm Jen Bartashus. I'm a senior equity analyst with Bloomberg Intelligence. I'm also the consumer team lead for our research group, and I cover the consumer staples sector. But we've got a great panel available here today to talk to you about what's going on. And I'm going to ask each of our panelists to introduce themselves and talk about their funds.
Hey everyone, I'm Darcy. I'm with Volvo Group Venture Capital. Usually this is a point that I have to specify. This is Volvo trucks, buses, construction equipment, not your favorite super safe SUV that you've had for 57 years. In this room, probably don't need that clarification. We're the strategic venture arm of Volvo Group, so we're a team of career VCs investing on behalf of Volvo Group and really looking at the forefront of disruption that would benefit Volvo, our underlying customers, or the industry as a whole.
Gartzman, co-founder and managing partner at the Dock. We are vertically focused VC, invest in maritime ports and supply chain startups. Our investors and partners are shipping companies, port operators, logistic companies, and family offices done their fortune in the space from Japan, Singapore, Israel, Europe, UK, and US, pretty global. And always on the lookout for the new bold founders to back. Happy to be here among these distinguished investors. Thank you all for coming.
Hi there. I'm Lisa Morales-Hellebo, and I am founder and managing director of REFASHIOND Ventures. We're an early stage fund that invests in companies that are refashioning industrial value chains. We invest across data and AI, advanced materials, advanced manufacturing, and next-gen supply chains, logistics, and some supply chain finance. What else do you want to know about me? I'm New York-based. We invest only in US-based companies, sorry. And we're currently, we've deployed about 51 checks into companies since September 2021, so we're extremely active.
Hi, Brad Svrluga, co-founder and general partner at Primary Venture Partners. We're based in New York. We are, at the moment, I think the largest standalone seed-focused fund in the country. We're investing out of our fourth fund, which is a $280 million fund, $1 billion of total AUM at this point, and generalist IT focused, but specialist at the individual level. And I and my partner, Zach Fredericks, who is roaming the halls here today as well, spend all of our time on industrials and supply chain.
Awesome. So just a reminder, there is a QR code up there, so we do encourage you to send in questions as we go along. But it should be no surprise to anybody who's in the audience that it is a tough time for the capital markets. We've seen very low liquidity in venture capital for a few years. Exit strategies are very difficult, and the timelines have really changed tremendously. And so that's sort of the backdrop, and yet there's still a lot of disruption happening in the supply chain. We're at a really fascinating and critical moment where things that were black swan events are just no longer black swan events. And so what I'd like to start off with is just asking our panel, in the middle of things, pirates, and low water in the Panama Canal and ground wars. What advice do you have for founders, and how important is that for them to find partners with the right expertise?
The right expertise is critical. I mean, right now, we're in advanced materials, and that's a fairly new space for early stage investment. There has been a lot of innovation across advanced materials because of the push towards circularity. Can everyone hear me?
Yeah.
But a lot of these companies have raised hundreds of millions of dollars, but are still not able to scale and actually go to market. The issue that I have seen there is that they're getting bad advice. So who you put on your cap table is critical to your ability to actually have the right strategy and make sure the tail isn't wagging the dog. For example, a lot of circular textile companies are being told, go get me brands. But brands keep moving the carrot, and they all want something special and unique to them. My advice to advanced materials companies in our portfolio is get me industrial partners and factories because they already have the orders and all the brand customers, so you can find the one right raw material that will scale across the largest pool of customers and give you volume purchase orders at a premium to start. Otherwise, you're always going to be chasing the brand's demands.
Yeah, I think one of the biggest changes from a couple of years ago that, 2020, 2021 hype markets is there were tons of tourists in the market at the time, and people were, huge capital providers were trying to find, where's that coming from?
I don't know.
Is it easier if we just shout?
Okay, is that gone? Feedback gone. Anyway, the tourists are gone. And I would say, this is always true, but it's even more true now. You need to be talking to investors basically who are here. If you're building a supply chain technology business and you're talking to an investor that didn't show up at Manifest, stop the conversation. They're not going to be the right partner. They're probably not going to invest. There's a lot of people in the market right now who are actually not super actively writing checks. Wow, the echo stopped. Yeah. But they're out there meeting companies. They're out there building pipeline. They're out there paying attention and thinking. But you want to be talking to people about, like, how many supply chain deals have you done in the last year? What's your qualify us. If you can't sit down and qualify us, and by the way, it may make us feel a little uncomfortable at the moment when you're digging in and asking us hard questions about us and our focus areas and our point of view on this issue or that issue, but we actually like it because it tells us that, you're being incredibly thoughtful about this marriage that we're dancing around in the same way that we are, and that needs to be a two-way street.
We don't want to be just a check.
Fully agree. By the way, how many entrepreneurs in the audience? Raise your hand. Oh, nice. You are the bold ones. I wish to meet you. To build on my colleagues here, it's very important to balance your cap table with investors, strategic and private ones. One advice is if you bring a strategic partner into your cap table as investor, that is also a potential customer, bring more than one, preferably 2 or 3. Otherwise, it could be perceived as a corporate solution of one of them. And like my colleagues mentioned here, ask our questions, vet us as investor as well. It means a lot about you as founders.
So kind of building off of that, what advice do you have for founders, for companies that are in growth mode, and they have to balance corporate investors and private money, along with the key partners or key, strategic customers, and everybody seems to have an opinion on the best path forward. So.
Yeah, happy to lead it off. I know this is going to be a bit of an ironic statement to say because startups are all about moving fast and breaking things and so on and so forth. But my biggest piece of advice is time. And just specifically in our space that we're all functioning in, you look at various different stakeholders. VC markets are crazy right now. And so investors are dealing with demands from their underlying LPs and lack of liquidity in the system. They're thinking more critically about the deals that they're doing, so on and so forth. Time is always the best friend. Tactically for founders, the more runway that you can give yourself, whether it's cutting burn, whether it's making tough decisions, whether it's planning well in advance for when you're going to need that next capital raise, it's just going to make everyone's life easier. And again, that marriage between investor, whether institutional fund investor, whether corporate, so on and so forth, time is always of the essence. And then whether on the customer side or strategic investor side and so on and so forth, my biggest advice as well is time. You look at Volvo Group, we have 100,000 people. We've been around for 100 years around the globe. There's a lot of different doors that we need to knock on. There's a lot of different cats that we need to herd and so on and so forth. Teams like mine try our absolute best to reduce that friction and move things fast, but it always takes time. There's just more cooks in the kitchen and so on and so forth. And again, those end investors and customers and so on, that especially if you're in the middle to enterprise upper market side of things, they have deeper pockets, bigger checks that they can cut, whether as customers or investors, but it's going to take time to do all of that. So my biggest piece of advice is time, acknowledging there's some irony in that statement of if you're a venture-backed startup, you're on a hamster wheel of burn rate and round to round and pressure from your investors and so on and so forth.
What was the question? I couldn't hear.
The question was really just about advice that you have on, for companies that have to balance a lot of different people with opinions. So,
Advice for startups in this market? Sell. I mean, now is your time to shine. And if you have a great product, stop reaching out to VCs and wasting your time. Become BFFs with your customers. Ask them if they think your product is valuable, if they'll give you a year's contract paying up front. Sell, sell, sell. You are now the superheroes because everyone realizes that supply chain is their weakness.
So we have a question that's come in from the audience that I want to integrate because I think it kind of fits in. The question is, what's the VC market's reaction to some of the recent high-profile failures in supply chain tech startups?
I think if you're talking to good VCs, shrug our shoulders, move on. Like we all know that we all in our own portfolios, if we're being honest with you, have companies that were overcapitalized, that maybe never should have gotten capital in the first place, but were able to in the 2019, 2021 stages. And frankly, I think that some of these high-profile failures in supply chain and all other sectors are incredibly healthy. Like this industry historically, I'm a seed investor. Historically, if you have 50% of your companies fail, that's fantastic as a seed investor. But in the last 6-7 years, that number has been radically lower. I don't think because we've been like magically, wildly better pickers than we've historically been, but because the market was propping up too many companies with too much capital, independent of whether or not they had solid fundamental unit economics and business models. And so we're returning to focus on the right stuff. And a company like Convoy or anybody else, it collapsed under the weight of too much capital and a flawed fundamental model. And when you have that much capital sitting on top of your cap table, like that becomes an insolvable problem. So it's a shame, but it's healthy for the ecosystem, and it's better for us all to be resetting expectations and building in a much more practical way.
I'd also add to that we all are paid, at least by and large, to be optimistic contrarians, to think big, to invest in disruption and so on and so forth. And so when I see something like these high-profile failures, I actually get excited about that. I get excited for, first and foremost, that we all talk about product market fit in our individual pitches, but I find VCs very rarely talk about founder market fit, and that founder that was employee number 7 at XYZ startup that went bust, that's a lot of battle scars that they experienced, but also opportunity for them to learn from the mistakes, to do it better the second time around, to take that experience and have that founder market fit for what they're going to build next. And I think kind of linking it to your other point, Jen, like at the end of the day, whether it's an up market or a down market in venture capital, whether it's a black swan event or a not black swan event, the world of startups thrive off of certain fundamentals. Great founders that are willing to move fast and create true disruption, big growing markets that are really attractive and ripe for disruption, selling your stuff to customers. Like you're building businesses. VCs often talk about growth at all costs, but like you want to make sure you're building a sustainable business in the long run and having profitability. So when I see these high profile failures, of course there's a lot of noise embedded in there, and I'm not here to say it's all sunshine and rainbows and butterflies, but it gets me excited about this next crop of founders that have learned a lot in that process and create that founder market fit.
Fully agree, and the harsh truth that most of the startups will fail. We are definitely not afraid from failures. I fully agree that employee number 7 in a failed startup is nice, but we prefer employee number 7 is a successful startup that built now his own startup and learn from the success story for his colleagues and founders above him. And maybe like the famous Silicon Valley episode about why I raised too much, I think you should work with your good investors and partners about how to build right and not too big your funding round. 2021, there was deals with, I don't know, 100x on revenues for different startups, Nautilus Labs and others by Microsoft that I never get it. And I don't think we should ever support such investment teams.
So we have another question that's come in that's kind of along the same lines. Why do you think some of these companies from the seed stage fail? And what are some of the most common denominators that you see?
So I think the single most common failure is lack of focus. And it's really tempting when most founders, and I suspect most of the entrepreneurs in the audience here, have really big vision for where they want to go and exciting vision and a vision that, I as an investor can rally behind. But when you're getting started, when it's 6 people and, maybe $1 million that you're getting rolling with, you can't even come close to attacking that whole vision. And so making the hard choices about what is the initial wedge product, what is the initial wedge ideal customer you want to go after, and thinking incredibly practically about that, and thinking incredibly practically about what you're asking of the customer, the partner, the whomever on the other side is super, super important. I see founders all the time who fall down in their idealism about they're so enamored of the solution that they're bringing to the market, and they're so convinced that there is ROI for the person on the other side of that commercial equation, that they're blind to the fact that the person on the other side, that may be a ROI positive decision that you're asking them to make, but it may be like the 17th most important thing on their list of pain points in getting that job that they have to do day to day, week to week done. And so if you're not addressing, a top 3 pain point for your would-be customer and choosing that as where you start, you are really setting yourself up for a tough uphill climb.
I think that a lot of founders think that being an entrepreneur is fun and sexy. I know we've had a lot of TV shows that have glamorized it, but if that's why you're becoming a founder, stop. Just stop wasting everyone's time. We specifically screen for people that this is the reason they believe they were put on the planet to build this. And that is usually tied back to some foundational part of their history, even all the way back to childhood. It's a really deep, burning passion. And if you don't have that, go get a job.
All right. So when it comes to investments in companies seeking to address supply chain challenges, do you think there's more opportunity for companies that are evolutionary or revolutionary?
Well, we're literally called REFASHIOND. So the reason we're called REFASHIOND is that we invest in paradigm-shifting companies. We believe that now is the time for these paradigm shifts. And incremental works for certain industries, but because of the convergence of all technologies, IoT, the single largest operating system to ever exist is being born today through IoT. Every physical thing can talk to every other physical thing. You have customization, on-demand, point of purchase, design, co-creation. All of these things have never been possible before. So why would you not try to invest in paradigm shifts? If you want to have unicorns in your portfolio, they're being born today. Just like the beginning of the internet, this is the beginning of the largest operating system to ever exist. You just need to know where to invest in industries that are, for example, being regulated for the first time in history, like fashion and textiles.
Like Lisa mentioned, if you are a founder without the passion to reshape the world, go get a job. If you're a VC investor without the passion, the risk-taking stamina to back revolutionary and bold ideas, don't be a venture capitalist. We literally try to find those bold founders that reshape business processes, use technology only as a baseline to change the way business is done in different vertical, de-silo the industry, etc. And let's talk again in 5 years if we succeed, but this is what we are after.
And we're all chuckling because, of course, this was a little bit planted to spark some debate. I'm the opposite. I believe in this space specifically, and I was a generalist VC before I joined Volvo Group, more akin to Brad's strategy, and going over all different types of markets. And what excites me about supply chain and logistics and the dynamic in this space is that within the evolutionary and just how this industry functions today, there are venture-style returns for investors to be had. Just given our timeline, don't get me wrong, for long-term transformative change within our industry, revolutionary is absolutely the way to go. There will be trucks on the road that don't have drivers in them. There will be more electric trucks, buses, take your pick, on the road over time. But when exactly all of that will happen, it's really hard to determine what those sort of timelines will be. And with a venture investor, specifically fund investors, you know that from the point that you cut your first check to the point that you give your money back to your investors is going to be at most about 10 years. So you need to think within that sort of timeline. So I get excited about the evolutionary because A, this is a $700 billion market for trucking alone, where 90% of fleets are 6 vehicles or less. Those two dynamics, gigantic dollars and hyper fragmentation, means that there are big businesses that can be built, deep problems on either end of that spectrum. It's not a winner-take-all binary sort of an outcome. Similarly, in terms of the tech stack, there's countless point solutions, TMS systems, ERPs, take your pick of acronym that exists out of there, that still, unseating all of that legacy is really hard, and there are some really deep, crucial pain points to shippers, carriers, OEMs, et cetera, that can have some really big dollars attached to them in terms of revenue accordingly. So I get excited about the evolutionary. My one-liner, if you will, is that wave one of innovation in this space that was kind of a tectonic shift was the creation of data, ELD providers and regulatory tailwinds in that sense. Our trucks have sensors everywhere and on everything, but so many different stakeholders have no idea what to actually do with that data. How do we actually apply that data? The left hand can't necessarily talk to the right because of these Frankenstein tech stacks that companies are paying hundreds of thousands of millions of dollars to maintain and are built in 1987. And we're guilty as charged on that front within Volvo and with our customers in that sense. So I'm really interested in the evolutionary. I think there's a time and place for the revolutionary, but it's closer in my mind to what we see over the tables down on the other side of the forum, and that's just not my personal style of investing.
I think you have to answer that question in the context of who your customer is. So I've spent a lot of time in the last 10 years investing in fintech companies, and specifically fintech infrastructure companies. And when you look at some of those companies, they're trying to sell infrastructure both to other kind of direct-to-consumer or B2B fintech players, and they're trying to sell infrastructure to traditional banks. And the answer for how revolutionary or evolutionary you can be depends on those. You could be wildly revolutionary when you're selling to brand new players who are disruptors themselves in a market. But if you want to go and try to sell to Bank of America or Chase or PNC or whomever, you simply cannot be revolutionary. Those kinds of organizations cannot digest that stuff. If you want to go out here and try to sell something to Old Dominion Freight that's wildly revolutionary, good luck. I'll bet against you every time. You have to answer all of these questions in the context of your customer.
And again, it's not for a lack of ambition for someone like a corporate like us. It's just pragmatically, again, 100,000 people around the globe. That's a lot of different stakeholders that you have to get aligned. Our ticket sizes for when we do invest in something are really big, and we have a very big brand whose reputation we need to uphold. We are thinking innovatively. We are certainly thinking about and trying to, but just mechanics, getting that many people into a room to make a decision can be really hard sometimes with a big, and Brad, to your analogy, a JP Morgan Chase, take your pick.
All right. One of the things that does tend to happen is that a lot of people start to think about supply chains as equaling only logistics. So when it comes to investing across the entire supply chain, and there's a lot of innovation across it, there seems to be a lot more opportunity. So where do you see more interesting opportunities across the broader supply chain?
Raw materials, advanced manufacturing, advanced materials, circularity. I think waste streams are sexy as hell. We're going to need to have localized, distributed, collaborative infrastructure, and that's the area that I've been deep in the weeds on for about 24 years, so I think we're just getting there.
Biased as we have so many LPs from the shipping community, and the supply chain is a global business, and 90% of everything travel by sea. So there is so many opportunities to disrupt the global supply chain by targeting this intersection between shipping, maritime, and logistics, and ports, and all the intermodality between all of them that we are passionate about them. And there are literally so many blind spot that could be solved by technology in the coming years.
So we've got a couple other questions that have come in. So the first one is, what are your criteria when you're evaluating a startup within the supply chain? And what are the top factors you consider, for example, ROI, solving an issue, scalability, et cetera?
I would say Joe mentioned founder market fit before. Like, what is the authentic? I think this is a hard industry to waltz into. You just came out of your Stanford MBA and you wanted to start a startup, and you read a book and you got excited. Like, the customers out there on this floor are not particularly willing to hang with you if you don't. I was talking to a founder today who was saying, like, yeah, we had a bunch of people who were like, wanted to call them truckers and didn't know that that's not what they're called in this industry. And that's the kind of mistake that you can't make. So that authenticity of, like, why are you doing this? Are you solving a lived problem? Something you have personal experience with is a big deal. And then I'm just always very, very, very relentlessly focused on your deep understanding of the customer, who they are, what their pain points are, what their motivators are, and if you have that intrinsic identification, that takes you a long way. And then the second thing, to oversimplify, but they just have to be really, really big markets, because we know that almost nobody ever gets 25, 30, let alone 50% market share. We know that you have to be able to kind of stub your toe, pivot a little bit left and right, and the bigger the market opportunities, the more room there is for you to navigate, bob and weave, and follow those winding journeys.
All right, we're going to sneak one last question in. So this says, what is the new annual growth expectation in light of post-COVID tech valuation resets, a pivot to sustainable growth versus growth at all costs? What are your thoughts on that?
We've always invested in companies that have very realistic valuations. So we've never been into this hype cycle, and we're usually first money in before anyone else sees it or gets it. So it makes it easier for us to help them not get out ahead of their skis and overexcited by somebody that's dangling a huge valuation with some big name that may not add any value and may derail them. We've literally had later stage companies come to us and ask for our tiny little check on their Series B round just so that they could have our advice on their cap table, because the other investors are telling them things that might kill their company.
All right, with that, we're going to give you 22 seconds back to your day. Please join me in thanking our panel for their great insight this afternoon.
Thank you very much.
Thank you.
Thank you.